Good afternoon, everyone. Thank you for joining us for the quarterly Albert E Sharp Model Portfolios Service webinar. We're going to do this on a regular basis. We're going to do this every quarter now. The reason why we're doing it now is that it's given us a chance to look at our numbers and also compare it against our peer group. So today we're going to go through the review of the performance of the suite of models, the suite of model portfolios. We're going to dive down into each asset class. We're going to look at what the main stories have been, and we're going to see how we've been positioned and look at the funds that we own. We're going to have a quick look at ESG and then a bit of a summary and an outlook. I should probably introduce myself. My name is James Crocker. I'm a partner here at Albert E Sharp, and I've been with the firm since 2012, and it's really my primary responsibility to help oversee the model portfolio service. I spend a lot of my time looking at the performance, trying to understand what we're doing, what our competitors are doing. But with that, we're going to dive straight into the performance, and Mark Atherton is going to quickly walk you through what we've been doing over the main headline numbers over the last 6 months and how it looks over the last year. So Mark Atherton, over to you.
Thank you, James Crocker. Thank you all for attending again. I'll move straight into this. We see ARC, or Asset Risk Consultants, as a sort of a barometer check, a benchmark, but the main comparator to the rest of the DFM community. So just to remind you, all the figures that go into the ARC machine are given by all of the DFMs, of which there are, I believe, around 90 now. They are real client data. They are net of fees. So it's a good level playing field, and it gives us a sense of our position in the world compared with our competitors. And they categorize them into 4 broad risks, which start off at cautious, going through to balanced, steady growth, and then equity risk. A lot of you will probably know that, but I thought it was worth just having a quick reminder. So the performance, James. So this is us versus the ARC equity buckets, and you can see that each of the equity buckets our models fall into each one as you'd expect. So going from the bottom, 1, 2, not often used model portfolio, but nevertheless, we compare that with LIBOR. It's our beat the bank portfolio, and this is, bear in mind, over 6 months, so it's the first 2 quarters of the year. And then we've got the cautious, which is represented by the model 2-3 moving up, as you can see on the slides. And I think it's fair to say that, generally speaking, probably apart from model 2, actually, we're comfortably ahead, slightly ahead. Maybe it's a bit too generous, but actually that did incorporate a bit of a rotational quarter, for want of a better expression, in Q1, from what we might perceive as quality into value in some areas, and I think James will cover that later on as well. So that was the first 6 months. Not blisteringly, staggeringly great, but nevertheless, we're comfortably ahead of our benchmarks, and that's a nice place to be. So over the year, as if by magic, you can see we're starting to move ahead a little bit more over that year's period, and then of course over the next, is it 3 year? That's the, oh, sorry, that's the 1 year, James. Okay. And then moving on to the 3 year. Oh. As well practiced as this was. So 3 years, we're starting to see this quality effect coming through, compounding through. And as you know, we're long-term investors. Compounding for any long-term investor is a great friend. And as you can see there, it's starting to really show its mettle. I mean, you know, if you look at the top line, and I appreciate not many people are risk 10, but nevertheless, it's pretty much double the benchmark. And even on the equity risk, it's still sort of 60–70% better. But this is really where it tells, and you'll probably not have clients that invest for just 1 or 2 or 3 years. They're usually going to be longer term investors. And of course, there we've doubled your money in 10 years. Whereas the ARC equity risk, which is the rest of the industry, remember, and it is an average of that industry, it is only 53.9% up. And you know, I don't want to. I mean, it's obvious. It's there for you to all see. So I don't need to labour the point really. But bear in mind, this is an industry overview. These are our competitors. So we're rather pleased with all of that, and we don't see any reason why it shouldn't continue, given our investment sort of thinking. James? So,
sorry, Mark.
You take over from there, please, James.
Sorry, the very slick segue there. Sorry, well, thank you for that. Thanks for that. Yeah, I mean, as you can see, that clearly over the 3 and the 5 years, the outperformance is pretty significant there. We're going to come on to the themes and to why that is. I would argue there are several enduring reasons why that is the case, why it's happened over the last 3 and 5 years and 1 year, and it's going to continue into the future. But let's try and narrow it down and just look at where we've been over the last 6 months, and just take a quick refresher on where we've been since Christmas. And you're probably aware that the FTSE All Share has had a reasonable run. The large cap, the FTSE 100s, have had a good run. We're in double digits for the first 6 months. Been a long time since we've seen that, but certainly the place to be over the last so far in 2021 has been again in the US, with the S&P up over 15% again. Definitely lagging in Asia and the emerging markets. Now, I've put this chart on here in local currency terms, but of course our clients don't look at this in local currency terms. They get their returns in sterling terms. So I'm just going to click on and just move forward. On your slide pack, by the way, hopefully you will have received, you're not going to see all of these slides. I've tried to just condense it down. I am rather concerned about death by chart here, so I'm trying to make this as digestible as possible. But anyway, here's the point. Sterling has an effect, not very material for the US so far this year, although it's been up and down. It's closed, not much changed. Really, the big change has been, if it's affected anything, it's been Japan. It's been the Nikkei 225 that was up in local currency terms and down in sterling terms. We're going to come back to that in a moment. So what have been the main themes in equity world? Well, the first is the great rotation, the so-called great rotation that the media have so happily called it. I have take a little bit of an issue with this, but essentially there has clearly been a switch from growth to value. As the market has realized that as the global economy comes back to life, the more lowly valued cyclical companies have benefited as people have switched out of the supposedly expensive jam tomorrow stocks. That's what I keep reading. I think that's one way of putting it. Another thing would be to say really that the bombed out stocks that were crushed under COVID, that may well have been oversold, have bounced back, and the more resilient names that didn't suffer as much haven't really fared fared quite as well. I mean, definitely there was a lot of that in Q1, but certainly as Q2 went on, if you want to call this a trade, that trade began to unwind quite quickly. So this also ties into the issue of inflation. And there was a definite feeling at the beginning of the year that the growth spurt that we're going to see from the economy would be associated with inflation, and that as a result of that, interest rates would have to start moving. Now, yields definitely started heading higher very quickly. But really, from your point of view, the way I look at this is your clients are more interested here. Bond prices went down. That's the most important point. And this was particularly acute for government bonds and the longer dated at that. Now, also a big issue in Q2 as the quarter went on, as the half year went on, the Delta variant started to take hold, and seriously in Asia, it had real nasty implications. And all of a sudden, this global growth mentality or the consensus that was beginning to form started to come under pressure. Now, although during all this, the Fed was certainly talking rates higher, the mantra and the sense within the bond market has certainly been that that although inflation has definitely picked up, it's proving to be transitory. We will see. Watch this space. Interesting. I guess another issue that reared its head on and off during the half year has been Chinese policy, business policy, particularly towards tech and intervention there. More recently in the property market as well, that's become a lot more topical in the last few days, in the last few weeks as well. Doesn't feel as though it's a story that's going to go away anytime soon either. Something to keep one's eye on. So going into the UK immediately, as you can see, FTSE 100 had a good run. Really, the place to be in the UK in the first half of this year was the small cap index, which bounced almost 20%. All to be fair, having been pretty crushed in the early part of last year. As a matter of interest, I've just put the AIM chart on there because AIM and small cap have actually diverged quite materially there. There is obviously overlap to a degree, but it's interesting how those indices have differed. Now, where does that leave us with the holdings that we've got? Let's start at the bottom. And I guess during this period where there has been this value type orientation, there has been a rotation of sorts that I can't easily dispute. It's affected the Buffettology fund, and for those who know us, this is one of our favorite funds that ties into a very, very clear process, obviously developed by Warren Buffett. But the performance, as you'll see in a moment, has been great. Linsell Train has struggled as well. Now, this is really our exposure to the large cap stocks on the whole. This is the main reason for this vehicle. And he's really struggled as well, to the point where Nick Train actually apologized to his investors in May over the performance, something that I really would never expect to come from Nick. But there again, let's watch this space and see what happens next. But certainly from our point of view, the big winner this the last 6 months has been the Gresham House Micro Cap Fund. May be familiar to some, may not to others, but certainly it's been a huge performer over the last 6 months. And as we go further out, let's just jump on another slide here in the interest of time. The Gresham House Micro Cap Fund is up 130% or so since we first bought in 5 years ago. The Buffettology fund as well has had a fantastic run. This chart actually shows us as we've come into July. It's included the last few days as well. Interesting how Buffettology is bit by bit picking up, as is actually Linsell Train. And here is, if people ask me what fund do you fancy the most, do I have a tip? I do not like getting drawn into these types of conversations, but here you go. The one thing I would say is that when you see the likes of Buffettology start to lag, or the Linsell Train fund start to lag, that is the time to buy it. If it's slightly out of favor, it will come back into favor. And as you can see clearly here, these guys have smashed their benchmarks over the last few years. Short answer is, we're certainly not going to change anything anytime soon in the UK. Moving on to Europe, not a dissimilar story. All of the benchmarks here are in sterling terms for the reasons I said earlier. And Europe was a pretty favorable backdrop. And again, you saw a lot of the financials, the energy stocks that we see there fared rather well. And a lot of the bombed out stocks were big contributors to the index. And as a result, the Man GLG Continental Europe fund that we're in lagged for similar reasons, I guess, to Linsell Train and Buffettology. But if you push this back over the last 5 years or so, this has been a great performer. I should probably mention we haven't been in this for the entire time. And in fact, we started buying it just around April, in 2019. Is that right, Alistair? Just give me a nod. April 2019. It was just the point it started to outperform.
January 2020.
Or is it 2020? So as time goes by, I completely lose it sometimes. But yes, we bought it around this time. It had started to outperform. Obviously got slightly hit with the rest of the market. But then, as you can see, the way that Rory Powell and his team invest there have given us huge outperformance. Again, it's a fund that we really like. Moving on to the US very quickly. Again, it's a bit of a story of two halves for the small cap Russell 2000. Suffice to say, the Nasdaq, having started the year a little weaker, rallied a bit, sold off a bit, and then came roaring back as we went through June to the point where all of them finished not a million miles away from each other. from our point of view, what does that mean? Well, actually, we were tucked in right in the middle of all of them. And again, it's interesting, as you can see there, how there's been a bit of a different path during the course of the year, but for various reasons. Bailey Gifford American being slightly more volatile, to put it mildly, than the others, had a great couple of weeks as we came into the end of the quarter. So let's take a step back and see what these funds have done for us over the last 5 years. This is the index here. As you can see, the Nasdaq, the tech was certainly the area to be. It's outperformed the broader S&P 500 by a long way. In fact, with small caps lagging quite a bit. But in terms of our funds and what we're invested in, we go on here and you can see that the Bailey Gifford American Fund has absolutely wiped the floor with most of the rest of the other funds and certainly the indices. Now, I should mention here, we didn't buy this until, January, the end of January 2020. So although there was a bit of outperformance here, we really benefited from the last 18 months or so, as the COVID premium arguably went into US stocks and really sent them on a tear. The Artemis US Smaller Companies Fund is one that we've liked for a long time, been very loyal to Cormac Weldon, which goes back to all of his time at Threadneedle, and that has been a very steady performer as well. And so essentially our aim here is to make sure that we're ahead of the S&P 500, and you can see that's been achieved very comfortably. Now, Japan, as I mentioned earlier, was subject to the movements in the yen. And as you can see there, the orange line, this is the Nikkei 225. So the man in Japan would look at the Nikkei and say, well, I think we're up about 6% or so this year. The man in the UK who would have bought the Nikkei, bought a tracker, but not hedged it, i.e. the return he got in sterling, would have seen himself down sort of 3% or so. That's all down to currency. And the reason I mention this is that currency is always something we try and hedge if we think it's possible. It's not necessarily that we've got a bearish view on yen. I am not that clever personally to make that call. But what I am conscious of is having lots and lots of exposure to overseas currencies, and particularly a currency such as the yen that could be structurally under pressure. It can materially affect returns. It seems to me prudent to make sure you hedge part of that. And that bears itself out over the last 5 years. And our portfolio main holdings here have been the Legg Mason Japan Equity Fund, and that has been hedged. That is a hedged variant. So that is the same return that the investor in Japan will have seen, which certainly helps when the currency is going against you. And I suppose the one thing that does jump out of this is that the Linsell train Japan, this is managed by Michael Linsell, who is Nick Train's partner, has had a great, and if I were to go back in time, he's had a hugely rewarding, I can't remember, it must go back decades almost, but his last 6 months, his last 8 months have been tough, to put it mildly. It's a very concentrated fund. There are about 22 holdings. But the way the market has gone, and maybe it's had a bit of a small cap push, it could be that he's struggled. But again, I am very loath to call time on a strategy and 2 investment guys there that have proven it over the long term. But not everything works. Not everything works at the same time, and there's no denying. It's not been a huge position, to be fair, in the portfolios, but it has been a slight drag on overall performance. Moving on to Asia, ex-Japan. Certainly over the last 6 months, small cap in orange, that chart there, that's been the place to be, as the large cap is still had a not too bad run of it, but there's clearly been a big gap. In terms of what we've been invested in, our main exposure there is the Schroeder Asian Alpha Plus Fund in yellow, but we've also got the small cap Discovery Fund, lagged the benchmark a little bit, but it's given us a good solid return. And again, grateful that we are in that. I'm glad that was a decision we took. I plant that little seed because we're going to be coming back to the importance of small cap in a moment. But clearly, having a weighting in there has given us 15%, whereas clearly, if we hadn't either gone large cap or ignored it, we wouldn't have received that return. I plant that little seed now. So if we go back to Asia ex Japan over the last 5 years, the Schroders Asian Alpha Plus fund in yellow has clearly materially outperformed, following the Keynes same kind of process that we like to see, of focusing on quality, having a fairly concentrated portfolio, but also making sure that the focus is on companies that can deliver consistent earnings growth. And that certainly has come out in the returns. And also the Schroders Small Cap Discovery Fund, although it's lagged a little bit as well, still nevertheless given us pretty chunky returns, bearing in mind the FTSE 100 is closer to 20–30% or so. Moving on to emerging markets, a not dissimilar story. Again, small cap was the area to be. Our main focus here, though, has been the Fidelity Emerging Markets Focus Fund, which over the last 5 years now has pretty much doubled, comfortably beating the index. Again, we've not been in, now this is the one, this is what we did buy in April of 2019. That was what I confused myself with, because almost from the moment we started buying it, it started materially deviating. We were really interested into why it was he was tracking so close. And sometimes it just really is coincidence. I think it really is that sometimes. But from the moment we comfortably discovered that he wasn't a closet index tracker, the outperformance really started to kick in. And there were some really interesting names in that portfolio. Li Ning, the sportswear, the Chinese Nike, if you want to call it that, not quite right, but you're on the right kind of lines. There's been a huge performer for him. And it's a really interesting fund. It is also one that we're going to be looking very closely since the departure of the manager, but that's probably a conversation for another day. But the team is still managing it very nicely at the moment in his absence. Technology I throw in there now. We've had tech since I joined. The reason for having an exposure to technology is very simple. We felt that this sector was going to give us a universe of companies that gave us a much higher probability of finding significantly superior levels of visible earnings growth. Companies that we felt had a higher probability of delivering consistent returns relative to other sectors that are out there, partly through disruption, very often through distinct competitive advantages that they've built themselves out. I think Zoom, although we do have Zoom buried in the portfolio, but Zoom is quite a good example that I can identify with. Obviously, talking on a Zoom webinar now, having used Zoom in the early days, they seem to have the best kit. It seemed to be the most user-friendly. I am now wedded to it in the sense that if I wanted to start using a different provider, I'm going to have to start to figure out and learn how to use their software. This first mover advantage creates customer stickiness. It's incredibly valuable. And of course, you see it with Microsoft and Google and all the rest of them. So over the last 6 months, as you're probably aware, this sort of growth in value has been, in tech's favor and out of tech's favor. The white index is the world index. This is what we're trying to beat. And as it happens, we've fractionally missed it. I put the red line in there is the Allianz Technology Trust, which is an investment trust. Actually, this is actually really one of our favored holdings in the sector. But the problem is with the fact that these model portfolios that we run are based on the platforms, it's quite difficult very often dealing with investment trusts. And so the reason I flag this is for a lot of our clients, you will be very familiar with the Allianz Tech Trust because it features in a lot of the bespoke portfolios that your clients have with us. And it's been an incredible performer because as I look now for over 5 years, you can see what we're trying to do here really ultimately is beat the world index. But relative to, if you're going to buy tech, you need to know what the benchmark is. And that is the orange line there, which is the MSCI World IT Index. The Global Technology Fund, the AXA Framlington Global Tech Fund is what we've had in the portfolios. That's the yellow line. That's beaten it quite nicely, but quite clearly the Allianz Tech Trust that we prefer has done even better. But bespoke portfolios, happy to have conversations about that, how the model portfolio theory, a model portfolio service, how the thinking and the theory behind that translates to bespoke, but that's for another time. But happy to pick that up if we've got any questions coming in on that. So moving on to fixed income. When I look at this area, although we can look at spreads, we can look at yields, we can look at benchmark break-even rates, the reality is for my clients, they want to know whether or not the bond market is going up or down, and whether or not their fund or their holding within that is participating. So the way I tend to look at this whole sector, as I do with, I guess, with other asset class, is to basically look at the underlying indices and try and get a sense of where we want to be and how we can get exposed to this. Now, clearly what you can see here is that the most volatile area has been the white line. Well, not necessarily the most, but it's the most volatile in this chart. Index-linked gilts. These are long-dated government issues. It's really important to remember that the reason mainly why they've been more volatile than the conventional gilts is the fact that this white line has much longer date, longer duration, and for that reason they are riskier and they're therefore more volatile. If you were to try and match these off, the performance would actually be really quite similar. It doesn't mean that index links have gone up because inflation is in the system. Do not misread that. I've put it in there though. The reason why I have is because a lot of our competitors buy into this very index. This tracker appears all over the place. And to be fair, it's worked quite nicely at certain parts over the last 5 years, but we do not have direct exposure to gilts. We made that a conscious decision quite some time ago. We felt that having a blanket policy decision was far too blunt a weapon. When we are fighting in this market, we need to be changing our mind on a fairly short-term basis. This needs to be given to experts. And so what we've essentially done is that we've used a lot of strategic bond funds in this area. And as you can see, maybe if I go back, all of the main indices here are underwater over the last 6 months. But actually, if you look at some of the funds that we're in, to be fair, some of them are going to be dealing in overseas bonds. This isn't entirely apples for apples, and I don't want to pretend that that's not entirely the case. But the point is, we can effectively, if we're trying to manage the risk in this area, we can quite happily eschew the eschew the gilts and buy, let's say, the Schroeder Strategic Credit Fund, which is quite happily in positive territory during the year. Also, one of the Artemis Corporate Bond Fund struggled a bit during the early part of the year, picked up a bit. That's a fund that we like a lot. We spoke earlier this week with the Artemis Strategic Bond Fund, and James Foster was slightly ruined the fact he'd had a slightly disappointing 6 months or so. Well, maybe it is in positive territory. Now, don't forget, this is one of the key points here. When we are buying these funds, we are looking for an absolute return. It's not a question of trying to outperform. We basically do not want to buy stuff that's going to end up losing money for our clients. And that's what we see the risk of with just buying long dated gilts. If we look further out, if I move this on, fixed income over 5 years, you start to get a much bigger sense here of quite how volatile this these index-linked bonds have been in the UK. I mean, the return's been pretty comfortable, and I guess most people would be quite happy with that. But I would argue, do not forget how risky it is when you are investing in long-dated bonds, even if they're government bonds. So the chart I would be more inclined to follow here is the iBoxx sterling non-gilts, or basically UK corporate bonds. This yellow line, I apologize, it's a bit busy this, but you can see it's made a broadly positive contribution over the last 5 years. That is kind of the chart that we want to be buying into, or want to be sort of closer to. And so moving on to look at what we've been in. Well, let's break this down. Let's start with the Artemis Corporate Bond Fund, a strategic bond fund. That's actually given us very nearly the same return as the very volatile index-linked gilt, but it's done so with a far more comfortable ride. The Baillie Gifford Strategic Bond Fund has done really well as well. again with a much smoother ride, but it's comfortably beaten this index. And in fact, the Royal London Global Bond Up has been a real stormer with a very, very steady progression, admittedly a sharp drawdown in March, but it's come back and put it back on and more. I mean, here is one of the key points. You look at this drawdown here, and when people tell me, well, the part of the reason why we bought, I don't know, index-linked gilts is because they're not correlated. They are correlated. You can see they are, because in a downturn, everything correlates. To be fair, how it unravels after that is a different matter. But I do not easily buy. I am buying a fund because it is uncorrelated. Really doesn't wash with me, because we can see what happens in a crisis. And I know that all too well from bitter experience in 2008. So just as a bit of a catch up, just for consistency, that the other lower risk assets that we've got in our portfolio, again, just to repeat, we buy this on a total return basis. We are buying stuff that we think is going to go up more often than it's going to go down. It is really not much more complicated than that. It does go back to the original Warren Buffett, probably his most famous quote. In investing, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And it permeates everything that we do. It's probably more important, arguably, in the lower risk assets, because these are for our clients in portfolios in the beat the bank portfolio, in the Model 2 and in the Model 3. These are the guys who do not want to see their portfolio crushed when things start to take a tumble. And as you can see over the last 6 months, although we've had a difficult backdrop of growth versus rotation that doesn't favor us really, I guess, but also of generally of lower bond markets in general. Despite all of that, we've got 4 out of our 5 funds that end up in positive territory. And the one that's clearly struggling here is the Artemis US Absolute Return Fund, that is admittedly deeply under review at the moment. Let's just look at this quickly over 5 years, and you can give you a little bit more context. A lot of people ask us, why do you buy these equity long short funds? And one of the key answers for me is that we think we can understand them. We think we can get into the head of the manager, and we think we can buy into these returns with a high level of probability of return. And I guess I think probably one of the funds that gives me really amongst them the most pleasure here is the Blackrock European Absolute Alpha Fund. So basically, they've got a very, very talented team there that has changed. When I do go back to this period here, you saw a bit of fallout here, and you saw Blackrock deal with that very quickly. And the management team there are very, very impressive. But they have steadily from that point on given us nice, easy returns. But why do we buy these funds? Look at the drawdown here. I mean, this is certainly one of the huge benefits, and it is a bit buried. I appreciate that. But the Artemis US Absolute Return Fund, in March of last year, the drawdown was minuscule relative to other things. Now, admittedly, the Smith & Williamson Defensive Growth Fund took one hell of a pasting. I mean, I would argue there's very explainable reasons for that. That wasn't necessarily well reflected in the fund, and it did come roaring back. All of these funds do slightly different things, and we're in them to basically give us a positive return. And I would argue it's done what it said on the tin there. So let's see how this works here. I'm battling with these animations here a little bit, but just following on from Mark's original reflection of the performance, let's have a little look at how we've done in chart form. And this is the Beat the Bank Index, and you can see that over the last 5 years, we measure this against LIBOR in the sense that our clients just want to beat the bank. Now, I think there's a huge caveat here in the one thing that we know very well is that as soon as you move out of the bank and put it into the financial markets, you are going to start to take a disproportionately large amount of risk. It's sometimes a lot for the clients to take on. And certainly that little dip, or say that dip back in March last year, in the COVID sell-off, we certainly felt the pain. But over time, the whole point is here is that we've definitely we've beaten our index, and we've beaten it by quite a lot. So it's like trying to nail jelly to the wall here, trying to control this this animation. But you can see the picture. And over 3 years, over 1 year, you can see that. Sorry, a cautious portfolio. Looking back over 5 years, again, the early parts we were struggling a little bit against the index, but you can see clear blue water starts to emerge over time. On the balanced, this is probably our biggest holding, probably most clients in balanced. We've got this is our model 4 and our model 5, and you can see against the black line, the index there, we've bit by bit, very steadily compounded, and you can see it's nice outperformance. I just ram home the point here. If we look at this, the difference between a 30% return for a balanced portfolio from our competitors, which has been the average in the ARC balance, compares to 45, 46% for our model 4, or very nearly 60% for our model 5. I mean, what does that represent? It represents outperformance. Yes, it does. It also represents a cost. These are all after fees. These include our management fees. And so what this represents is the opportunity cost of not buying the Albert E Sharp 5. And essentially, this benchmark is essentially a collection of trackers. This is essentially what happens if you go passive. This is the cost, I would argue, I wouldn't argue, this is definitely the cost of being passive over 5 years looking back. Now, the argument will be, well, who knows what's happening in the future? And I don't have any crystal balls either. But the one thing I would say is that there is, I would argue, something very significant in the way that we manage money that's led to this. Now, that's great for balanced, but if we moved on for the equity risk, it becomes far more clear. Our model 10 here has absolutely wiped the floor with a broader index. And you can see that 7 and 8 were quite close together, but 10 has more than doubled over the last 5 years, compared to more like 50%. We've given twice the return of the underlying benchmark there. So moving on from these charts here. So this is what I get to deal with at the end of each quarter. I sit down and I plow through as many of our competitors' numbers as I can get my hands on. These are all pretty much available on their website. And this is our return over 1 year. How we've done this is against equity exposure. Now, admittedly, it's a fairly blunt way of looking at it, but I think it certainly gives you the sense that the more you have in equities, the higher the return. Of that, it's clear. Excuse me. And you can see that over the last 12 months, we're right at the top of the tree. Excuse me. Don't forget, of course, that the last 12 months, and certainly the last 6 months, have not been exactly conducive. This is not necessarily entirely the environment that's going to suit us, but nevertheless, we're still well towards the top of the pile there. If you look at 3 years, however, it starts to become quite clear that we're a long way behind the pack. And I will leave it for the viewers to have a look at who we were competing against in 1 year and who we're competing against over 3 years, and try to see whether or not there's a large variability in returns amongst our peers. And I'll leave that for the reader to take a look at. And as I said, I hope if it's not clear on the screen, I hope it is clear in the slide packs that I sent round. Incidentally, if anybody doesn't have a slide pack for whatever reason and wants one, send in a Q&A. We can get these out to these. Apologies, I probably should have mentioned that right at the very beginning. But over 3 years, you can see, the other thing I would flag here is that look at the scale. So if I'm just picking out 6 here, we've brought in about 37, 38% in over 3 years. Against our nearest competitor there, there's about 26. That's about a 10% gap. So when you jump onto 5 years here, don't forget that this gap is now more like 20%, bit less, obviously. But this scale can be a little confusing. but the gap of performance is very, very significant. And it's very significant against some of the portfolios towards the bottom here, who have been broadly tracking the indices. And this, I would say, proves, or it's proved why it's worked, at least until now, why being active pays. And it's really what we're all about. If there's nothing else to pick up from today's meeting, it is the sense that the Albert E Sharp Model Portfolio Service is all about active management. Now, just one of the final comments I just want to throw in here goes back to inflation, because I sort of danced around the subject. Here's the point. Do we have a strong view on what is happening with inflation? Well, I think the one thing that we did say earlier in the year is that the bond markets are going to take a lot of convincing that inflation is back and it's back to stay. And certainly the bond market is not pricing that in as it stands right now. But the one thing I learned a very long time ago from Milton Friedman is in his quote, inflation is always and everywhere a monetary phenomenon. And everything that he says is worth listening to, I would say. I mean, personally, he's a kind of a hero of mine for lots of different reasons. But this stayed with me when I learned it at my A-levels a long time ago. Now, the reason why that's relevant, of course, and I'm sure a lot of you have seen this chart, is the growth in the US money supply and also around the world in developed markets as well, where we've seen this huge, huge increase. And although it's tailed off in the last few weeks, the last few months or so, we're still seeing 15% odd money supply growth, which is still miles ahead of what we've generally seen over the last 30 or 40 years or so. That is really material. As I said, markets are suggesting that inflation is transitory. It's not pricing in an aggressive Fed tightening. Well, it's not now, but maybe it's not for now. I would say ignore Milton Friedman's quote at your peril. But I am not one, and we're not one, for making big binary bets on macro outcomes based on the fact that we know so few people can do it. Milton may well be right, but it may take a long time for it to come through. And timing on this is always the difficulty. That is why we happily outsource that to the likes of James Foster at Artemis and our other bond fund managers in particular. Obviously, bonds is what matters here, but it is, of course, it's hugely important in equities as well. So what if we do see inflation? And the question I get asked is, shouldn't you be buying gold? Because if we're going to see inflation, I mean, gold is a great hedge. Well, is it? I mean, I don't know. I mean, it might be. Property, it could be. Property's done incredibly well this year so far, certainly residential house prices. I go back to what Warren Buffett said, bearing in mind that Warren Buffett has made himself one of the richest men on the planet, and that includes making money during some of the most heavily inflationary periods on economic record. So what he had to battle through in the 70s and the 80s was also when he made his money. And really what he says, so, when in doubt, I have to say, when in doubt, what would Warren Buffett say about this? And it's very clear. He says, buy companies with pricing power. If you're going through a period of high inflation, you need companies that can pass on those prices. You do not want to be tied down with companies with huge variable overheads. When I say variable, I mean overheads that run the risk of going up due to inflation. You need robust margins that can withstand inflationary pressures. We've seen that to a degree with Unilever, which is actually one of the companies that we really like. But Unilever admittedly has had a bit of a margin dent this quarter. But is that transitory? Well, I would argue it is. But also, if you've got companies that have got high borrowings, then they're going to potentially face high levels of debt repayment. And that is a horrible millstone to have around your neck when you're also facing ever higher prices that you can't control. And the lack of control is a terrible, terrible issue, because the point of this leads to corporate failure. Corporate failure is something that we talk about a lot. That is something we're trying to avoid. But the point is, pricing power, robust margins. Well, hang on a minute. Doesn't this sound familiar? These are all the traits of the companies that we have in the portfolios. in other ways, we talk about this all the time. We want to own companies that have got competitive advantages. We want to buy into companies that have got deep moats, that are highly defensible from the attack from outside competition. We want to see companies that generally have great cash generation and also great management. It sort of goes without saying to a degree. But hang on a minute, this is quality first. So the point is, if we see inflation creeping up and hitting us, well, we're already correctly positioned in the first place. And we're positioned in the same way that Warren Buffett was positioned in the 70s before he got hit with huge levels of inflation and then went on to be one of the richest men on the planet. I mean, we shamelessly talk about Warren Buffett, and I don't worry about this in any way. You know, our methodology and how we look at the world is unashamedly aligned with what Warren Buffett says and what Charlie Munger says. We want to manage money in the same kind of way that those guys would, but actually really, I suppose, that say we manage the money. No, it's our job really to find the managers that manage the money and to have similar kind of mindsets. And I think to a very large degree, I think we've done that, but it's a quest that carries on, and it's something that we, you know, that we never stop seeking for, is trying to find that next good manager. And I mean, of all the quotes we've got, I mean, one of them, it's amazing how they sort of come back to you. But one thing that, I mean, I'd heard this years ago, but Charlie Munger said, it's remarkable how much long-term advantage people like us have got by trying to be consistently not stupid instead of trying to be very intelligent. And I would hope to a degree that encapsulates really how we look at the world. We are not trying to shoot the lights out. We're not trying to be super bright, trying to second guess what's happening. We're trying to make basically low probability investments on the behalf of our clients. So just very finally, so trying to tie that all together. So year to date, where has the outperformance come from? Well, the answer is buried in amongst exposure to the US, exposure to tech, certainly in the second half, in the second quarter of the year. Our exposure to small cap has definitely helped us, but also the other side of that is that a lot of our competitors will have had quite a lot of exposure to gilts. They will have had quite a lot of exposure to gold, two areas that we've definitely been underweight in. The diversifiers, in inverted commas, we don't own, but some of those have been very weak as well. On the longer term, well, the longer term outperformance has come from this focus on quality that we talk about. It is this complete conviction in active management. There's a very, very important structural reason also why we've got an advantage against a lot of our competitors, and it's down to scale. And it's the fact that a lot of our competitors are so much larger than us, they simply cannot buy into some of the smaller funds or to some of the smaller cap funds as well. If they just make a very small allocation to certain funds, they're going to close it down almost overnight. It is a problem that I look forward to the day that we face that problem, but the reality is that's a very, very long way away right now. But it gives us a really genuine, huge advantage. There is another issue as well with this, is that a lot of our peers will not go near some of the small cap funds that might have higher OCFs. Why? Because they're always trying to keep the OCF down, the portfolio charge down. And if you don't have the performance, then the one thing you can talk about is how low your OCF is. Now, that's not to mean our OCF is expensive. We're about 0.7-ish as it goes across the portfolios. It varies a little bit. But the point is, we don't worry about the OCF if we're getting the returns. But if you don't have the returns, then you're going to try and focus on cost. Of course you are. Hence the race to the bottom that we're seeing to a degree. And so finally, just, compounding is a huge, huge part of what we do. You don't see a lot of turnover in our portfolios. We like to let the winners run. And the 8th miracle of the world, compounding, has been a huge friend to us over the last about 5 years and beyond. And the very, very final point here is a simple desire to win. It is our aim to beat the competition. It is to be at the top of the league tables when it comes to performance. And very simply, I just don't hear our competitors say that. It's just not something we tend to hear. Well, I can unashamedly say that is our aim. So on that, I'm going to pause for breath. I think we're going to take any questions in a moment, but I'm just going to pause for breath for a moment and just pass over to Alistair. We're not going to dwell on this for too long, but just a quick look back on ESG. The main focus today has been the core models that have been on the platforms. The one thing I will just say very quickly before I forget this is, for those of you who haven't used us before, who maybe use Aviva, who might use Transact or Standard or whoever it may be, in order to use our portfolios, you need to be switched on, as it were. You need to be able to see us. So if you can get in touch, and if you want to invest in the portfolios, let us know, and we will make sure that you can physically see them, because on a lot of the platforms, that's physically not possible. So I was worried about not mentioning that. I've got it out there. Please remember that for anybody who hasn't dealt with us yet. But on that, I'm going to mute myself, and I'm going to pass over to Alistair, who's just going to touch on ESG and where we've been, not just over the last 6 months, but beyond, since we've been more formally recording the performance. So Alistair, over to you.
Yeah, cheers. I'll just skim through this very, very fast. We launched our ESG suite back at the tail end of September 2020. Just to remind everyone, we followed the same process, and within the ESG framework, Albert E Sharp considers ourselves the arbiter. We will decide what is ESG compliant or not. A big part of that is we do not consider alcohol focused companies to be non-ESG compliant, so they do fit within the portfolio. As a result of that, we can maintain quite a high overlap, certainly in certain sectors of the portfolios, especially within the equity holdings. And as a result, we believe that we can deliver what is a ESG compliant framework to your clients without having to compromise on any of the performance. So one of our big bellwethers for this is how well do we, track the performance of our core suite. And as you can see from the screen in front of you, we've achieved very strong returns. They're pretty much in line with the core models. Higher up the equity exposure, more of active management, and some of the growthier funds would have pushed us ahead of the core suite. And down below, it's more within the credit space where we might fall behind a bit. But ultimately, if you want a good idea of how this strategy or framework might have worked over the last 3-5 years, I'd point you to the core portfolios, and they'll give you a pretty good idea. James, do you have this since inception performance chart? Yeah, cheers. So as I mentioned, performance running from 30th of September 2020. Not exactly a environment that is conducive to, out of the gate massive outperformance, but we're pretty happy with the start of this. And as we go over time, we'd expect those numbers to widen out over our respective benchmarks. Early days, but good start. And as we'd expect, pretty much in line with the core suite. So that will sort of cover off the ESG. I'll now give it back to James in the interest of time, and we'll run through some Q&A.
James, sorry, can I just butt in there slightly whilst covering the ESG? I should remind listeners, viewers that we don't charge a premium for that service. It is the same charge as you would be charged for the core model suite. And part of the reason for that is simply that actually there is so much overlap that the research function, the work involved in generating those ESG models, whilst at the very start was quite labour intensive, actually the ongoing management, because we've got an awful lot of crossover of funds, we're doing the work already. So genuinely, why should we charge a premium for that service, even though we have other slides which will show you how ESG friendly they are on a scoring basis. So yeah, sorry, I just thought I'd throw that in there. Sorry, James, up to you.
No, that's a very fair point. Just conscious that we haven't had. I've sort of had a few questions by text, but I think it's stuff that I can pick up. I'm just very conscious. This was aimed to be 30 minutes. We've managed to do it in very nearly an hour. I apologise, that's me rambling, but I do get a bit tied into into all of this. This is kind of my life, I guess. So apologies for that. I guess the one thing I should just mention, CPD certificates will be available for those of you that have endured this for the last hour. So I will be pinging those out. But I guess really, I suppose, unless we've got any more questions, I'm just going to have a look. I can't see any there. I guess we can call it a day at that. This is going to be available in a recording, so I will send around a link afterwards, just in case you want to forward this on to anyone. But I suppose on that, if nobody's got anything else to say, I guess it's a real big thank you for us to everyone for joining us today, and we will see you all very, very soon. Thanks a lot for joining us. Cheers. Bye.
Thank you all.